Hello everyone, my name is Elliot Yu. I'm co-founder of Energy and Income Advisor. Now I think most investors are well aware the stock market has performed well since the end of 2020. To be specific, the S&P 500, well, it's up about 45% in the past 3+ years, and that's around 12% annualized. However, this chart may surprise you. Now this chart shows the performance of the S&P 500, the NASDAQ 100, and all 11 S&P 500 sector indices since the end of 2020, which as I said is a period of a little over 3 years now. Here's the S&P 500, up 44.9% over this time period. Here's the NASDAQ 100, up a bit less than the S&P 500, despite a very strong showing last year in 2023. It's up about 43.3% since the end of 2020. Now here's the S&P 500 Technology Index, Information Technology Index. Now that's a group many investors I speak to believe to be the market leader right now. And it's up an impressive 67.7% since 2020, more than the S&P 500. However, tech is not the best performing group, not even close. As you can see right here, the S&P 500 Energy Index is up 194.2% in just over 3 years. That's almost triple the gain in the S&P 500 Information Technology Index and more than 4 times the gain in the S&P 500 index itself. Listen, I know some of you may be wondering if, after gains of that magnitude, this energy bull market may be nearing an end. It's only logical to ask that, and it's something I'm frequently asked when I'm interviewed or when I speak to investors at investment conferences. My answer is simple. This energy supercycle is closer to the beginning than the end. We're still in the very early innings of the supercycle. One of the main reasons for this is that the world and financial markets are only just now waking up to the fact that global energy demand and demand for fossil fuels specifically is growing and will continue to grow faster than supply for years into the future. You see, in recent years, many have come to regard fossil fuels like oil, natural gas, and even coal as dinosaurs, a dying industry with only a few years of life left before government targets to reduce carbon emissions, so-called net zero pledges, plans to phase out internal combustion engines in favor of electric vehicles, and massive subsidies for alternative energy technologies render those fossil fuels obsolete. As recently as last October 2023, the International Energy Agency, IEA, published a report subsequently cited by just about every mainstream media organization on the planet, claiming that crude oil, natural gas, and coal demand would peak globally all around the world by 2030, before the end of the current decade. There's only one little problem, you see. Demand for these fuels isn't declining, quite the opposite. This is a chart from the Energy Information Administration, which is part of the U.S. Department of Energy, part of the federal government, showing global oil demand since the late 1990s. As you can see here, oil demand did take a dive in 2020. Global lockdowns imposed by governments the world over to contain or supposedly contain COVID, along with travel restrictions and curfews, had the impact of a sharp reduction in global oil consumption, which you can see here. Yet look what's happened since then. According to the EIA, global oil demand hit a brand new record high in the summer of 2023 of 102.35 million barrels of oil a day. The agency expects global oil demand to top 104 million barrels per day by the end of this year and reach as high as 105.68 million barrels a day by the end of 2025. That's the last forecast period on my chart here. Now, even the IEA, International Energy Agency, which has become something of a laughingstock in the industry in recent years, for consistently and vastly underestimating global oil demand, they recently revised their own forecast for global oil demand sharply higher this year, forecasting falling global oil inventories, now that's oil in storage all over the world, through the first half of 2024, in marked contrast to just a few months ago when they were forecasting a surplus, excess supply of oil. So how about coal? Now that's the dirtiest of the fossil fuels, and the one fuel that climate activists and politicians often talk about phasing out near term. Well, through at least 2022, the latest year for which we have data from the Energy Institute, it certainly doesn't look like coal is going anywhere. I'll grant you, coal demand isn't growing like oil demand, as you can see on this chart. However, it has taken a few steps higher in the past few years and is now sitting near all-time highs. And according to the same source, coal still accounted for about 35.4% of total global electricity generation in 2022. That compares to about 14.4% for non-hydroelectric renewables like solar and wind. So let me ask you this. How exactly do you think the world will, quote unquote, phase out more than a third of electricity consumption by 2030 or even 2035? Certainly not by expanding the US artificial intelligence technologies markets. According to research firm McKinsey, electricity demand from US data centers alone will more than double by 2030 by the end of this decade, mainly thanks to artificial intelligence and the growth in that technology. And that brings me to electric vehicles, also known as EVs. The state of California, here in the US, recently reported that last year, annual sales of battery electric vehicles reached 379,727 light vehicles. If we add in sales of light-duty hybrids, total sales of what the state calls zero-emission vehicles, or ZEVs, was 446,961 light-duty cars and trucks. That's a 25%, one-quarter share of total vehicle sales in California last year, up from 18.8% in 2022, about 6.8% in 2019, and that was, of course, the year before the COVID outbreak and related lockdowns hit sales of cars and energy demand short term. That's far higher than the national average of about 7.5%. National average 7.5% in 2023, California 25% sales of ZEVs. The US government divides the country into 5 parts. Now these are called PADD, P-A-D-D. That's an acronym that stands for Petroleum Administration for Defense Districts. Now the entire East Coast, like right here in the state of Florida, is PADD 1. It's called PADD 1. The West Coast is called PADD 5. The Gulf Coast, for example, Texas and Louisiana, for example, and states like that, that's PADD 3. Now PADD 5, the West Coast, includes the states of California, Washington, Oregon, Arizona, Nevada, and Alaska. Now in terms of oil demand, California is by far the largest state in PADD 5. Also, the western PADD 5 states tend to have some of the toughest emissions rules in the country, not just California, but a lot of those other states as well, Washington and Oregon in particular. Many have mandates and targets for phasing out fossil fuels. Yet despite all this, total oil and refined products demand in PADD 5 is absolutely flat since 2009, as you can see here. As I just mentioned, US oil demand took a dive in 2020 amid lockdowns. However, what's interesting is despite the massive gain in EV market share in California since then, a little over 7% of sales in 2020 to 25% last year of those zero-emission vehicles, actual demand for oil has increased far faster in PADD 5, which includes the state of California, than for the country as a whole. According to the EIA, total demand for oil and products, refined products, in PADD 5 jumped 12.6% from 2020 to 2023, again in PADD 5, compared to about 11.1% for the 4 other PADDs in the US. So how exactly does anyone think that the rise of EVs is going to allow California to eliminate fossil fuels in the next few years, let alone a fast-growing emerging market like India, where oil demand has grown almost 50% since 2011 alone. It's a ridiculous fantasy that's an insult to simple math and the realities of the global economy and energy markets. Here's another inconvenient truth for you. Since the end of 2021, President Joe Biden has authorized the release of more than 319 million barrels of crude oil from the Strategic Petroleum Reserve, or SPR. That's the nation's emergency oil stockpile. They're now back to the same level as the early 1980s. The Department of Energy recently even canceled a plan to buy back 3 million barrels, just 3 out of 319 million, for the SPR by this summer. Yet, despite record-setting releases from SPR and the government's claims of massive gains in U.S. oil production thanks to shale, West Texas Intermediate oil prices are still in the mid-80s a barrel. And according to the government's latest weekly release, U.S. commercial inventories of crude oil, gasoline, and distillate fuels like diesel and heating oil are all below the 5-year seasonal average, just a few months before the start of summer driving season. Fellow investors, that just doesn't add up. If the U.S. oil market were truly oversupplied right now, and if EVs were truly cracking demand, then inventories should be ample. Prices should be flat or falling, and the SPR would be hundreds of millions of barrels larger than it is right now. Look, I started closely following energy markets about 25 years ago. And over the past quarter century, I've been to countless industry and investment conferences. I've spoken at many of those conferences. I've been a guest on numerous radio shows, television networks like Bloomberg TV, CNBC, and even Fox News. And to be honest, looking back, a lot of those appearances and events kind of blend together in my mind. However, I'll always remember being asked on as a guest on a radio program way back in the autumn of 2004, pretty early in my career in the financial markets. I remember that day 20 plus years ago, mainly because oil prices had recently crossed the $50 a barrel mark after spending most of the 1990s around 20 bucks a barrel. I got into a heated argument, or maybe better described as a debate, with the host over whether oil at $50 a barrel was sustainable. I argued we'd see much higher prices. He argued the opposite, that the world has ample supply, even excess production from new fields, slowing demand growth, and that prices would sink back into the 20s. The rest, as they say, is history. I'm not telling you this to boast or brag now. I'm telling you this because 2004 and early 2005, almost 20 years ago, was the last time global markets started to wake up from their complacency regarding the global oil demand and supply balance. It's the last time markets started pricing energy as a growth industry rather than as some sort of anachronism to be ignored. That's similar, very similar to what we're seeing right now. Markets are waking up, despite the IEA's repeated claims that global oil demand is peaking, despite all the talk about dramatic growth in EV sales, net zero emission targets, and internal combustion engine phase-outs. Market participants are starting to recognize the reality behind the media headlines, the reality of growing, even accelerating global energy demand in a world where fossil fuels still account for 81.7% of global energy demand. And much like 2004, 2005, the energy industry is poised on the cusp of a historic valuation re-rating. Now, from the middle of 2004 to the middle of 2014, a decade, the S&P 500 Energy Index jumped 254.41%, beating the S&P 500's 111.6% gain, including dividends, by a more than 2-to-1 margin. And I can tell you firsthand, a lot of energy stocks did far better than the index as a whole. Energy was the top performing sector in the S&P 500 over that time frame, out of all 11 sectors. And I must warn you, my research confirms the current supply-demand balance is potentially even more dangerous than it was 2 decades ago. Now is the time to act, to protect and grow your wealth through the energy supercycle and inflation surge currently underway right now. That's also why I'd like to invite you to take a risk-free test drive of my energy-focused premium publication, Energy and Income Advisor. It's a service I co-founded with my friend and longtime colleague, Roger Conrad, almost 12 years ago. And we seek to identify and recommend the best income and growth opportunities in the energy sector. For a strictly limited time, Roger and I have authorized 90-day risk-free trials to the service, triple our normal risk-free trial period of just 30 days, for all new annual and 2-year readers. We're still offering 30-day trials to new quarterly subscribers. To start your risk-free trial, simply click the button adjacent to this video and sign up today. If you're not 100% satisfied, then call or email us to cancel your membership within the first 90 days for a prompt, full refund of your subscription price. I guarantee it. We're also offering 5 special reports to all new members to get you started with some of our top recommendations and the main energy investment themes we're watching. And over the next few days, we'll be releasing our next regular issue of the service, covering our latest thoughts on a long list of exploration and production companies, E&Ps, including our top picks and some names to avoid. Finally, on April 30th, right at the end of this month, Roger and I will be hosting one of our famous online Q&A chats with readers. Log in to the special website and ask any question you like about energy, oil, natural gas, the markets, the economy. We answer all questions asked in the chat and send out a convenient PDF transcript to all readers for perusal at your leisure. We do mean all questions, by the way. We spent as long as 10 hours online to ensure all questions are covered during the chat. To start your risk-free trial, click the button adjacent to this video or give us a call toll-free on 1-877-302-0749 to place your order by phone. Just be sure to tell Sherry, our customer service manager, that you watched this video with me, Elliot, to make sure you get all the discounts, special reports, and benefits I mentioned in this presentation. Thanks again for listening. I hope you found the presentation useful, and I look forward to welcoming some of you as new trial members of our Energy and Income Advisor service here in just the next few minutes. Thanks again.